Hello, Jayson Bates here, owner of Electrum Financial, located right here in beautiful Scottsdale, Arizona, where a mortgage is not a flip of the coin. If you like the lowest rates at the lowest cost, then allow me to put my 30 years of experience to work for you. You've got nothing to lose. Here is this week's mortgage market at a glance. This week, there were no new bank failures, but concerns about which bank might fail next caused worry and speculation. The announcement made by the Fed on Wednesday, coupled with these concerns, caused interest rates to decline despite the Fed's rate hike. In addition, two reports showed a decrease in home prices. Since Silicon Valley Bank's failure earlier this month, financial markets have significantly changed their trading patterns. Prior to this, when economic data suggested that the Fed would be more accommodating, both stocks and bonds would increase in value. But keep in mind when bond values rise and yields rates decline. Now conversely, when something appeared to irritate the Fed, both stocks and bonds would decrease in value. This resulted in a fascinating mirrored effect on the charts. In the previous chart, you may have noticed that the mirror image pattern starts getting less obvious over the past few weeks. If I zoom into a more granular view, you can see that the pattern has shifted to one that's more purely correlated, especially this week. What's happening is a flight to safety driven by fears about the banking sector. This means people are selling riskier assets like stocks and buying safer investments like bonds and gold. This trend has followed news about the banking sector and the Fed's comments on the topic, which seem unrealistic. But time will tell. Although the Fed was expected to hike rates, the hike had little impact on the market. Instead, traders focused on Fed Chair Powell's remarks about the risks posed by the banking sector. Powell's comments were seen as paving the way for the Fed to be less aggressive with rate hikes going forward. However, the Fed can't make forecasts that speculate about more bank failures because it would create more, panic. The Fed's outlook for its own policy rate remains around 5% through 2024. Financial markets are already betting on roughly a full point of rate cuts by the end of 2023 compared to the current Fed funds rate just under 4.9%. Here's another way to look at the market's view versus the view presented in the Fed's forecasts, also known as the dot plot. The red line shows market expectations while the purple line conveys the median view among Fed members. Mortgage rates tend to follow 10-year Treasury yields, which both reached their lowest levels since early February this week. Rates could suddenly drop further if there are more bank failures or concerns about a contagion. Conversely, a gradual increase in rates could occur as traders become less cautious over time in the absence of additional bank failures. However, inflation and the economy are also factors that could affect rates. If inflation trends lower, the housing market could reflect this trend. While home price inflation is not measured this way, two reports on home sales revealed a continued decline in home price inflation this week, with both new and existing home sales showing negative year-over-year growth. Let's address whether the current housing market situation is in the beginning of another housing crisis. The answer is no. The recent increase in housing prices happened for different reasons, and the financial conditions of the mortgage market are more secure. Moreover, there is not an excess supply of new or existing homes like there was in the past housing crisis. I've previously mentioned this fact multiple times in previous videos, so check them out. The recent drop in home prices is a correction that the market needed, and it could either stabilize or go deeper depending on the geography and the broader economy. However, when looking at a chart of the actual prices, it gives us a slightly different impression. Did your mind's eye see it? If not, here's a different take on the same information. The current home prices are still high compared to the stable trend before the pandemic. And combined with the elevated rates, affordability is a significant issue. However, if prices drop too quickly, it could signal a problem in the housing or economic sector, causing buyers to wait for further price drops. Home prices are seasonal, and while they increased in February compared to January, they did so at a slower pace than last year. The recent banking issues have caused the market to become more neutral, with traders waiting to see how it plays out at home and abroad. Relevant economic data in April, such as the jobs report and consumer price index, will also influence market movements. While there are arguments for both higher and lower rates, the case for higher rates is less convincing than it was a few weeks ago, even according to the Fed. So there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I'd like to be your broker of choice. Until next time, take care and stay safe.